The broadcast is now starting. All attendees are in listen-only mode.
Good morning, and welcome to today's Florida Institute of CPAs webinar. Today's program is CIRAs, Disaster-Related Accounting and Auditing Issues. This course explains the varied and unusual details of the accounting and auditing issues of the CIRA industry and the aftermath of hurricanes and other disasters. This presentation deals with the accounting and auditing issues that make the CIRA industry so different from many other industries. The session details disaster-specific asset recognition positions for CIRAs, specific disclosures for assets, reserves, revenue and expense issues, and reporting on required supplemental information disclosures. The GAAP differences between financial reporting and tax reporting are confusing and unusual to the unwary. Specific disclosures for capitalization policies, restrictions on use of facilities and assets, asset recognition and measurement of assets transferred, and non-monetary exchanges create confusion for professionals in disasters, which this session will clarify. Financial statement form and formats are explained for specific state reporting requirements. Disclosures are also at play in statutory financial reporting. My name is Adam Hubenthal, e-learning manager for the Florida Institute of CPAs. I will be the moderator for this webinar, which is scheduled to run from 10 a.m. to 12 p.m. Eastern Time. Before I introduce our speaker and we jump into today's program, there are a few housekeeping matters I need to cover. If you experience any technical difficulties or need any assistance, please contact GoToWebinar Support at 800-263-6317 or visit GoToWebinar Support on the web at support.citrixonline.com/GoToWebinar. If you have any questions or comments for the speaker, you can submit these using the question control panel located on the right side of your screen. You'll see an orange-colored arrow that will allow you to expand and contract the question control panel. In order to claim CPE credit for today's session, make sure you answer the polling questions that come up on your screen. By responding, your attendance is being monitored. A link to download a copy of today's PowerPoint was sent previously via email. The instructor will be showing the same materials on screen during the webinar. If you still need to download the materials, please log into the FICPA website, click My Account in the upper right-hand corner, then choose My eMaterials. There you'll find a PDF of today's PowerPoint slides. Our speaker today is Cecil Pat Patterson. Pat Patterson, CPA, MBA, is a member and owner of Patterson CPA Group Incorporated. Pat is an award-winning, nationally recognized author, speaker, and discussion leader for continuing education courses at numerous state societies. He has experience at the local and national firm level and as an adjunct university professor. Pat holds an MBA from the University of North Florida and is a CPA with Patterson CPA Group Incorporated. His firm provides accounting, tax preparation and tax planning services, wealth management services, and consulting for businesses and other professional firms. The AICPA has recognized the firm for work in a virtual office field. Pat has been awarded the Florida Institute of CPA's Outstanding Discussion Leader of the Year for 2016 award and has been named an FICPA Outstanding Discussion Leader in years past, has received the FICPA's Writing Excellence Award, and has also received the New York Society of CPA's Distinguished Discussion Leader Award. Let's please welcome Mr. Pat Patterson. Pat, I'll turn it over to you.
Thank you, Adam, and welcome to everyone. Good day to you. Hope everybody is up for this. We're going to be talking pretty quickly and pretty fast, and hopefully we'll cover a lot of the materials. Today's session is on disaster-related accounting and auditing issues, mainly looking at the CIRAs, Common Interest Realty Associations. This is something that's very important to us. We're going to talk about different types of disasters, but we would probably focus, since it's the Florida primary audience, on the hurricane issues that come up. Again, by way of background, I'm a practicing CPA. My office is in Ponte Vedra Beach, Florida. And as such, we do a little of everything that most CPA firms do. Adam has already gone through some of these issues that we have, and so I thank you for that. Let me add just a couple of other pieces to this. First of all, I'm not an attorney, so from time to time you're going to run into some legal issues that may involve real estate or other matters, and you may have to consult your own legal counsel or the CIRA's legal counsel. Now, these materials have been prepared solely for continuing ed purposes and designed only for that context. They've not been acted on and don't represent an authoritative or official position of any organization. And additionally, these standards, pronouncements, procedures, and statutes can change from time to time. It's up to you to stay current and updated on these. Some reproductions of the actual standards may not be complete. You would need to look to the actual for completeness. And having gone through that, let's talk briefly about our course objectives. We want to give you some information on disasters and common interest realty association matters for 2017. And we focus on 2017 because that's where we've had, basically within the last 12 months, a couple of hurricanes that have come through the Florida areas. Now, disasters, of course, also incur, and other associations around the country, could be anything from a landslide to an earthquake to flooding, you name it, tornadoes, it can happen. We also want to give you some practical solutions to some difficult issues and problems in these disaster situations, and to allow possibly a discussion on advanced issues of audits, reviews, and compilations involving CIRA disaster issues. Now, we don't have a great deal of time, so I would ask if you do have questions or you need to contact me later, please don't hesitate to do so. The CIRAs have a lot of problems that get involved with disaster issues. One is the common property. Not everybody understands that the shell of the building is owned usually by everybody in common, by the property owners. But the interior space is something else that's involved, and that's usually owned by the individual property owner and solely. Reserves are also issues that come up with the CIRAs. We'll talk about what kind of CIRAs we have, but mainly we're speaking today of homeowners associations, condominium associations. There are other CIRAs that have everything from the CIRAs involving the timeshares to co-ops, fractional interest, other things. We'll be talking briefly about those. Now, the capitalization policy is very important to the CIRAs. This is one of the required GAAP disclosures, by the way, and it's probably one of the most missed disclosures in the CIRA industry for CPAs. We're also going to talk about the disclosures to the financials that are important and need to be made. There's some differences in the disaster areas as compared to normal disclosures, which we'll get into. And bad debts could come up if the CIRA is wiped out completely. You may end up having some bad debts that you take a look at. Budgets tend to drive the financial aspects of the CIRAs. Budgets are the primary so-called money engines of the common interest realties. Disaster planning, after we get through today, I hope you'll be able to see that this is so important to everything. Disaster planning is critical to all of the associations, making sure they know who and what to do and how to call and when to call and all of those issues. We'll talk more about that. And of course, there's some statutory or regulatory problems that we need to get involved with. Now, they do have some common characteristics. They are separate legal corporate entities. They have required membership. If you own a unit in a CIRA, you're supposed to be a member. They have some shared common areas. This is areas that this is sometimes hard for people to understand. It's not just their swimming pool. It's shared by everybody who lives in the facilities. It's controlled by a board of directors, and sometimes the boards aren't quite sure about what to do. In many cases, they're made up of people who are simply residences, and they're not business-type people. They're not professionals, and so sometimes you get little problems with boards. They are nonprofit organizations, but that doesn't mean they're nonprofits for purposes of GAAP. I'll explain that a little bit more. By definitions, we've got co-ops, homeowners, condos, timeshares, etc. These are all considered common interest realty associations, and the Cooperative Association is probably the easiest one to understand because it's simply a form of ownership that the corporation owns all the real estate, including the improvements and the responsibility for all the maintenance, debt service, repairs, so forth. The owners don't really own any of the real estate. They merely own shares of stock or certificates in the corporation. That makes it kind of an easier way to look at it. This ownership interest allows them to lease from the co-op, to occupy their units, or even sell their units. Members are assessed carrying charges for units they occupy. It's very much like other CIRAs. The corporation functions in the same way other CIRAs do in maintaining real estate providing services. Next is the Homeowners Association. It's a form of land development in which various residential and non-residential structures are clustered to allow optimal use. Now, I say non-residential because sometimes you have clubhouses, you have tennis courts, you have golf courses, other things that are in place. Most of the time, the single-family dwellings and lots are owned by the individuals entirely, unlike in a condominium. And then the so-called amenity structures, the clubhouses, et cetera, are owned in the name of the association. We'll get into that in a few moments. There's also some set-asides, usually in many HOAs. Now, to become an owner in an HOA, you simply buy a lot and improvements, or you buy a lot and make improvements. And again, the title of the common property is held by a common interest realty association, generally an HOA, which has obtained it probably at no cost to the association because of developer turnover as to what went into that for the homeowner. Then the association does assess the funds for the funds to maintain the property and provide the services. Now, condominium is a little different form of ownership. It's really a legal form of ownership. We always think of condominiums, we think of them as a almost like a property issue, but it's really not. A condominium is just a legal form of ownership. Each owner has title to a defined interior space within a building and an undivided interest in the common property, such as the grounds, recreationals, exteriors, and all of those issues that go with it. The condominium association generally owns no real property, but it certainly may and oftentimes does. But it is responsible for maintaining the common property and providing the necessary services. And the common property for this purpose includes both that owned individually and the property that's owned by the association. In some jurisdictions, the condos are actually established as trust, and in which case the entities may own the real estate and all the improvements, but the trust is a little different animal. If you have any of those, let me know and we'll try to talk about them. But if they do, the accounting and reporting in condominium trust is the same as for cooperatives. And the condominium may be commercial or residential, as will be a co-op can be commercial or residential. Homeowners, you really don't find, I've never seen a HOA that actually operates as a commercial entity. Some people try to say, well, they've got the golf course or the tennis courts or something they charge to go in, but those are usually separately formed and they're separate entities, not just part of the HOA. And then a timeshare is an interesting piece. A timeshare is a form of ownership. Each owner has a time interest, a shared interest, commonly referred to as interval use. And what happens in that case, you have a right to use the unit for a specified number of weeks during a year. Such interest can be in the form of fee simple, literally title changes hands, or it can be in the form of a situation where you have fractional ownership associations. Sometimes in some of the Western resorts, particularly ski areas, you see houses that are owned by several families and they share the use of that house during the particular period of time. Now, there's variations on all these, of course: master associations, townhouses, property owners associations, planned unit developments. They all kind of roll into the CIRA area, the CIRA industry, and we're going to be looking at some of those. Now, the governance is here in Florida. Our condominiums, it is the Condominium Act, Chapter 718, and the related Florida Administrative Code rules. Here's polling question number one. Polling question number one. Remember what Adam said. It's very important that you answer the polling question. It's not a matter of being right or wrong. It's a matter of answering the question. So with that, I'll turn it over to Adam.
Thank you, Pat. For Florida condominiums, the state statutes are Chapter 718. True or false? Just want to thank everyone for joining us today. Thought you'd like to know that there are over 200 individuals listening in this morning, so we certainly appreciate every one of you who have chosen to join us. We hope that you find this very informative and helpful in disaster recovery and dealing with recent issues. Give everyone a few more seconds here to finish getting their votes in. And here are the results. 97% said true, 3% said false. Back to you, Pat.
Thank you, Adam. And I want to mention again that this does qualify for accounting and auditing credit. So it's very important that you answer those polling questions. Again, it's not a matter of right or wrong, it's just getting the answer in, and that's very important to us. So the cooperatives for Florida governances does have Chapter 719. Chapter 719 is for co-ops and the related administrative codes. Timeshares use Chapter 721 of the Florida statutes and the related Florida administrative code rules as well. HOAs had a late arrival as Chapter 720, and they have very few actual Florida administrative code rules like the other CIRAs do, but homeowners associations pretty much operate under Chapter 720. The FACs are primarily for elections and recalls and a few other procedural type things, not necessarily the finance and accounting issues. So those are very, very important. They are available online. You can go to the Florida Division of Florida Condominiums, Timeshares, and Mobile Homes. I usually just Google up Florida Division of Condos, and you'll get to that site, and you don't have any problems. There is a phone number listed, 850-488-1122, and a fax number. Now, I make a note that this particular division is not for HOAs unless it's for elections. They don't handle financial matters. They don't handle complaints, that sort of thing. So the division is not for HOAs primarily. It is for the condominiums, the cooperatives, and the timeshares. And we'll talk a little bit more if you have any issues on that. But to get any kind of legal satisfaction, you'll probably have to go through some sort of a civil suit to get any type of activity for that. Now let's take a quick peek at various types of disasters. We've had several here in Florida. There's been a number of them that have come up. Maria, we've had Irma, we've had Matthew, and all the way down at the bottom, of course, Andrew back in '92. But disasters also include things like earthquakes on the West Coast and Mexico recently. We've also had other hurricanes that went into the Texas area and Louisiana area. Sandy went all the way up into the Northeast. We've got earthquakes all over the place. The large one in 2011 off the coast of Japan caused a tsunami that damaged the nuclear power plant. Katrina in 2005, horrible, horrible storm. There was, and of course, the terrorist attacks on New York's World Trade Center is also considered a disaster. And so we see a lot of that kind of stuff that comes into these disasters. And if they affect the CIRA, that's what we're talking about. They can cause some obvious widespread damage, destruct property, in addition to the tragic loss of life. They can also have business activity disruption in affected regions, and they indirectly impact on the financial reporting. The accounting for asset impairments we'll be talking about, disclosure problems, how do you disclose some of this? The income statement classification of losses and recoveries, how does insurance apply and get into this? And then additional exposure to environmental remediation liability. So there's a whole area here of the A&A issues that we're going to focus on. The first is assets. A disaster may result in the impairment of assets. Consideration for impairments is often difficult because you're not sure how much is really damaged immediately. It may come in to be later that you know what's going on. And the analysis of whether or not there is an impairment after a disaster is often difficult in the CIRAs because of many uncertainties about the prospects for that CIRA. In other words, many of the assets are not recorded on a common interest realty association. So for long-lived assets, this would be like, let's just think of it in terms of real property. The complete destruction of a long-lived asset that is not already fully depreciated would most likely result in a loss to the entity. Any remaining carrying values would probably be written off. This is complicated for the CIRAs because the asset may not be recognized on the balance sheet. For instance, we know that part of the common property will be that owned by the individuals themselves, like a condominium unit owner. The interior space of that unit may be a loss to the individual, but not to the CIRA, not to the association, but the structure of the building, maybe the roof, the amenities in some cases could be losses to the association. And in some of these cases, these assets are not recorded on the books and records of the association. So you've got to sort of know what common property is by definition, and we'll get into what records you can look at to use that. And in U.S. GAAP on property, plant, and equipment and the impairment of disposal of long-lived assets is in these sections that are required, and you will find them in the ASC, the Accounting Standards Codification. Usually it's section 360 that we look at. Now, there can be any of the following: a significant decrease in the market price of a long-lived asset or an asset group. I'll give you an indication. Our office building, or our office structure here in Ponte Vedra, had water in it up to about 4 feet, and we ended up having a significant decrease in the market price of that long-lived asset. But we're redoing it, so we had some insurance recovery. We're also redoing it. We've got some issues that come along and cost to redo it, and hopefully that market price will be elevated back up again. You could have an adverse change in the extent or manner in which the asset is being used or in its physical condition. The current expectation that more likely than not a long-lived asset will be sold or otherwise disposed of significantly before the end of its previously estimated useful life. You could also have a significant decline in the asset's values to generate, or ability and capacity to generate income or cash flows, since the forecast of these things demonstrate continuing losses. So these are all part of that ASC 360-10-35-21. Now, where can you find that? Obviously, you can go to FASB.org. When you get to FASB.org, look under Standards. When you put your cursor on Standards, there'll be a drop-down window, and then you'll see Accounting Standards Codification, and you'll see Accounting Standards Update, which we'll be talking about as we go forward. The ASC 360 also requires that entities group long-lived assets to be held and used for impairment testing at the lowest level of separately identifiable cash flows. You remember this from the old statement of cash flows prior to 2009. You go down to what level do you generate cash flows? Well, we've got a situation with a CIRA that we might not own the actual unit that generates the cash flows, but we do own the building that unit resides in. So we could have some issues about how we're going to record it. Now, if we have done it properly from the beginning, in many cases, particularly in homeowners associations, you'll have those assets on the books and records. Condos, not necessarily, but the condos still do have to report some of those issues. Entities may conclude that the long-lived assets affected by a disaster are going to be sold, abandoned, or otherwise disposed of. And when the held to sell criteria in 360 is met, or when they cease to be used, and if it's not going to be, entities are going to be required to write it down if you're not going to sell it. And this is something you're going to have to use to write it down to estimated fair value, and it may even be zero. But a long-lived asset that's just temporarily idled or out of commission should not be accounted for as if abandoned. So we've got some issues there to be dealing with as well. I've had several friends that had condos on the beach, and the whole condo structure is gone. It's just a loss, a total loss. And then you get insurance recoveries that come into play with how that's going to be handled. Now we're going to get into a little bit of an interesting issue here: finite and indefinite intangibles. The impact of a disaster may trigger the need to test an entity's finite-lived intangibles. Now, I realize not everybody's going to have this. Not every association is going to have this, and so many don't. But if you do, you also are going to have to test this for impairment. This is the customer relations, the royalty arrangements, franchise agreements, or other impairments that may come up, and the entities may have to recognize those impairments through the ASC 360 by reviewing finite-lived intangibles. And the analysis of finite-lived intangibles is not that much different from the analysis of long-lived that we've already mentioned briefly. And entities' indefinite-lived intangible asset may also be impaired. This is when an event or changes in circumstances indicates that the indefinite-lived or lived, intangible asset is impaired. And there's a list of those that are in ASC 360. You're required to test this for impairment, even if its annual test for impairment occurs on a different date. So sometimes you get into issues where you have this impairment test, you made it last fall, but this year you got a different animal because you had the storm that came through and you got to retest it again. A disaster can also lead to circumstances in which the utility of inventory on hand. Now, some of you may say, oh, wait a minute, we don't have inventory on our association. Many associations don't. Some do, though, particularly those in resort communities. They may have inventories of linens. They may have stockpiles of, they even have like a store that they sell souvenirs in. Those are all part of this inventory that may have to be written down. Whether the impairment is caused by physical destruction or adverse change, the entity should assess if an inventory impairment or write-off is required. And so I'm just trying to give you some thoughts here of all of these issues. And again, what we're doing when we come up with these particular categories of assets and we say that they're impaired because their value today is less than what the cash flows might be or less than their fair value, then we have an impairment loss and we have to write it down. Receivables, almost every association has receivables. And you could have receivables that are affected by a disaster, but they need to be evaluated for collectability. And they may incur additional write-offs of receivables deemed uncollectible or may be required to establish additional reserves on receivables. Let me give you a quick example. Let's say that you have a special assessment from an association, and the association special assessment means that everybody's going to sign up for a note. Well, this note receivable is on the books and records of the association, but now the whole building is gone. So what happens to those receivables? Are people still going to make the payment to them? It depends on the bylaws and the rules that the association has been set up under. Generally speaking, yes, those receivables are still on the books and records, and if they're there, you may have a loss because you may have already recognized some of the revenue coming in from them and consequently have to take care of the adjustments for uncollectible receivables. Here's polling question number 2. Polling question number 2. Once again, this is an A&A session, so you want to be sure that you answer the polling questions in order to attain your A&A credit. I'll turn it over to Adam.
Thank you, Pat. Receivables from entities affected by a disaster should be evaluated for collectability. True or false? Once again, receivables from entities affected by a disaster should be evaluated for collectability. True or false? Just a few more seconds. Here are the results. Everybody said true. Back to you, Pat.
Thank you, Adam. Folks, everybody that's on this session, I know that what we're saying sometimes is important to note, but for most people, myself being a very practical person, I always like to figure out, how do we do this? What do we do? And this is sometimes one of the harder questions to answer because the situations vary so much. But basically what you're trying to do is determine, is it impaired by making an issue of what is its value now compared to before the disaster. And that's the real issue. If the value today is less, in most of these cases, the receivables and loans and other types of issues are going to be at their face, and their face is going to be the fair value. But all of a sudden now they become less because what they were for is gone, is destroyed in the storm. It's destroyed by the earthquake. It's destroyed in the hurricane, the tornadoes, whatever. So consequently, that receivable is impaired. And in many cases, you're not going to be able to collect all the amounts due. And such experiences usually indicate that you could have a write down for that, for the impairment of those issues. This could lead to impairments of like loans, and may be probable that contractually specified cash loans will not be collected. If the creditor modifies the term of a loan because of a disaster, it should consider whether the modification is called a troubled debt restructuring, which has other disclosure issues that come into play in troubled debt restructuring. What does troubled debt restructuring mean? It means any change to the basic loan, might be rate, it might be maturity value, it might be dates, might be payments, any of that is a troubled debt restructuring, and it's under ASC 310-40. And a loan that is a troubled debt restructuring is an impaired loan, and the impairment of measurement is discussed under 310. Securities. This could sound kind of strange, but I have seen this before. We might have declines in the market value of securities or impairments because of defaults, bankruptcy, or both, and they should be considered in the evaluation of whether investments are other than temporarily impaired. I'll give you a quick example. Some associations have made investments in stocks by forming a separate entity like the country club. So the clubhouse setting and the golf course is set up as a separate entity. The stock is now owned by the association. And is the association now, because the clubhouse is gone or damaged or destroyed and it's going to have losses, is that now impaired other than temporarily impaired? So we get into some interesting issues that come up with situations like that. Now, before we get too far into this next area, which is what we call extraordinary items, I'm going to just tell you, hold your breath for just a minute, because we're going to get through this and then we'll mention that it may not matter. A common financial consideration is, should losses like this, disaster losses, be classified as extraordinary items? The generally accepted accounting practice in the United States regarding this is expressed in the Technical Practice Aid, section 5400.05. This is accounting and disclosure guidance for losses and national disasters, non-governmental entities, and it states that basically it's not that unusual, it's not that non-recurring, and some of those issues may indicate, based on the inquiry, is it actually an extraordinary item? How would losses come about? How all these issues? I'm going a little quickly here. Then we say that the FASB ASC 225 describes an extraordinary item as an item both unusual in nature and non-recurring. And if you meet those expectations, then it's probably going to be considered an extraordinary item. However, the disclosures and the losses and the recording of losses and all that may be a moot point. Disasters are by their nature extraordinarily, as the term is generally understood. The FASB, for instance, in Katrina, the FASB informally communicated his view that losses resulting from such a disaster are not considered extraordinary items based on the term's use. And similarly, they discovered that the view of extraordinary items for losses in the earthquake off the coast of Japan would also not be appropriate. And then they even came out and said the terrorist attack on September 11, 2001 was not necessarily extraordinary either. But I mentioned earlier, most of this is now moot because of based on the release of the FASB Accounting Standards Update 2015-10. And by looking at the title, you can see exactly what we mean here. So the title of this particular update is Simplifying Income Statement Presentation by Eliminating the Concept of Extraordinary Items. Russell Golden, who's the chair of the FASB, was very good at sort of shepherding this through the FASB board, and the board is issuing this update as part of its initiative to reduce complexity in accounting standards. This update, 2015-01, eliminates from GAAP the concept of extraordinary items. Stakeholders have told the board that this is really, it's unclear when it's considered both unusual and infrequent. Therefore, it costs too much to do it, so we're not going to do it. And eliminating the concept is going to save time and reduce costs. So don't worry about that. in regards to disasters. There is no longer extraordinary items that need to be considered. And if you do have something that you're looking at going to the future, then don't worry about it. It's just part of your normal operational areas. Now, you can delineate disaster losses as a separate account within your chart of accounts and bring it in there, but it's not extraordinary, sort of what we say is below the line. All of that went into effect for fiscal years beginning after December 15th, 2015. So it's in place right now and will be for these storms. So this is just something to be concerned about and be considerate of. Now we get into an area of insurance that is really giving us some problems with this whole idea of the disaster accounting. We have to take a look at different areas of insurance. Not everybody is going to have the same thing, and there's many varieties of insurance that are out there. It may be rather challenging to a CPA and may require the assistance of an entity's legal counsel who hopefully has some information on that, or you may have to go get some special counsel for this. What you're trying to see is, does insurance coverage exist? Is it simply there? In determining the accounting for this, an entity should first perform an assessment similar to this. First of all, does the entity have insurance? That's the first issue. Second, is the specific loss insured? In other words, does the entity have insurance and whether the specific events are covered? Let's just take my office building, for example. My office building is across the street from the Intercoastal Waterway in Ponte Vedra Beach. I can step out the front door of the office and throw a rock and hit the Intercoastal without any problems. Now, we have insurance on the office building, catastrophic insurance. If we did not have specific flood insurance, the cost of rising water and damage to the building from the rising water, doesn't matter if it's salt water or fresh water, rising water would not be covered unless you had disaster coverage, unless you had it. So the entity could have insurance on the building. The building may be a total loss on the inside or even the outside. But unless the rising water is covered, then you have a problem because it might not be covered. Is there going to be disputes over the cause and extent of the damage? Take, for example, let's say that a tree limb is blown off a tree and goes through your front window in your office or in your association property or your condo, your homeowner, whatever, and the water comes in through that broken window caused by the tree limb going through it. Is it covered then? These are kind of disputes on the cause and extent. And in determining that amount, you have to consider what's going to happen for disputes with the insurance company and its likelihood that you're going to prevail. So these are some issues and questions that come up on this. Now, here's another issue that comes up. What is the financial viability of the insurance company? Can the insurance company pay? If you have a major storm that comes through your area and you're covered, you think you're covered, the insurance company may not have the wherewithal to cover all these losses. And so how can you rectify, for instance, I know of several major insurance carriers. They're nationwide, not the name of the company, but they're across the United States. And some of these have carved out certain areas, for instance, Florida, and they've put Florida as a separately insured state from the main body of all the insurance and reserves that are in the main body of all the other states. Florida is insured by a separate, has the same name, and it may be XYZ of Florida Inc., but it's because they don't want to damage the entire company by having to pay huge claims just because Florida had a major hurricane. So how would you check that? First of all, you take a look at the quarterly and annual statutory filings. You want to consider whether the insurer's surplus or capital is large enough to cover these losses. How much of the insurer's business is located in an affected region? That's what happened with some of these companies with Florida several years ago with Hurricane Andrew. They saw that they were going to have potentially, if there was such a storm again, imagine what would have happened with Matthew if the storm had come right up through the center of Florida with Andrew. It was, or with Matthew or Maria or any of the others. It was very, very interesting as to what was happening. And insurance companies tried to protect themselves. In other words, they insured the insurer. And entities, insurance broker or rating agency have already performed these assessments and may be able to provide you with some information. Be very careful. Be very careful with some of this stuff. What we have run into over time, let me give you another example. One of our clients had a building that was in multiple sections, and each section was joined by a covered colonnade. And the covered colonnade came into play and ended up having sidewalks, I guess you might call it. It was more like walkways, but they were rather hilly. They went up and down and so on. Well, this area became a real draw or attraction for teenagers using skateboards, and they loved going through the colonnade areas with these skateboards. And so much to the point that the people said, well, maybe we could do something to help them out, and maybe we can open it up at certain times and do this. And so they asked their insurance agent, could or would this be insured? The agent said, yes, it's insured. You're covered for everything. Okay, so the big plan started now. They're going to create this skateboard park in their colonnades. About a week later, they get a notice from the parent company, the main company having all the insurance, and it says, not only are you not covered for this, if you don't cease and desist and put signs up that this is illegal and not allowed, we're going to cancel the coverage on the entire company. So you've got to be very careful with some of that stuff, and your broker or your agent may have some issues that they're not aware of. An easy way to handle that is simply ask that it be put in writing. Ask that it be put in writing to you, and that it come from the parent, not necessarily the agent. The agent says, oh, I'm happy to put that in writing, but the agent may not be able to cover the losses you may have. So insurance entity ratings are also obtained. There's others like Moody's, there's Fitch, there's Standard & Poor's, AM Best. So there's a whole series of those that could come up. But not all losses from a disaster may be covered by the policy. Many insurances exclude flood damage. We've already mentioned that. Hopefully, you've got flood coverage in many of these. And you may have, look at what happened in Texas. They didn't think they were in flood zones, and some of them weren't. But Hurricane Harvey in Texas with so much water damage created flood problems. And some of these claims can be disputed if the insured entities and their insurers differ, and how much of this was due to wind versus flooding, et cetera, et cetera. And disputes can arise about whether the coverage exists. Finally, these disputes may arise regarding who's responsible for all the claims, or whether even the claim will be allowed. So you do need to be very careful as you start thinking, well, surely this association has coverage on everything they're doing. Maybe not. That's where you have to be very careful as an auditor or even an accountant working in there. If you're living in one of these associations, you need to make sure that your association is adequately covered. In other words, best uses, or the so-called best efforts, is what's used in the statutes to indicate about insurance coverage. Some cases, the coverage may not be sufficient to cover the entire amount of repairs required. One of the issues that's been popular in the last few years is these insurance companies are charging large premiums, which is not unusual. There's large premiums, but if you have high deductibles, the premium comes down and there is less. So what you may find is that the association ends up maybe having coverage for everything, yes, but there may be a $100,000 to $300,000 deductible, and there's no cash available in the association. So it could be a problem getting the units fixed or getting the repairs made because you don't have the entire amount of repairs covered. And it may even extend to entities that are not directly affected by the disaster. There's a lot of issues that come under insurance. We could almost spend a day just on insurance claim disputes and talk about the different cases and what's happened there. Again, probably the best situation I can talk to you about in insurance is talk to your agent, make sure that you put this in writing somewhere, not the policy, but have the agent say to you something like, in other words, and put it in plain English. Okay, here's polling question number 3. Polling question number 3, and remember the importance of the polling questions. Adam?
Thank you, Pat. For some, insurance coverage may not be sufficient to cover the entire amount of repairs required or asset impairments incurred. True or false? For some, insurance coverage may not be sufficient to cover the entire amount of repairs required or asset impairments incurred. True or false? So far, everyone's in agreement. Give it just a few more seconds to get your answers in. And here are the results. Everybody said true. Back to you, Pat.
Thanks. We're going to talk now, and we'll get into a few more practical details on insurance as we get a little closer to the end here. But under certain finite insurance contracts, you have an entity that pays a premium that would approximate the amount of expected losses into an account held by the insurer with the insurer. This is called a finite insurance contract. Now, if the cost of the loss turns out to be less, then the carrier gives back the difference to the insured. But if the loss turns out to be greater, then the insured pays an additional premium. So this is kind of like you're betting what it's going to be, and you're trying to make a payment to the carrier or to this contract that says, here's what it's going to be. And if it's more or less, then you have to, if it's less than that, you get money back. If it's more, then you have to pay more in. So it comes into a little bit of a problem. The main advantage is that these types of finite insurance contracts is a transfer of timing risk and not necessarily underwriting risk. So it's really just a timing issue that comes out. In April of 2005, the Practice Aid TIS 1200.06, accounting by non-insurance enterprises for property and casualty insurance arrangements that limit insurance risk, which helps identify features indicating that risk may not have been transferred. If the risk has not been transferred, then you could get into some situations where you've got some exposure there, and it could be a little bit of a problem. If the risk has not been transferred, then you have to apply the deposit method, which is outlined in ASC 340-30, which addresses accounting for insurance contracts that did not transfer insurance risk. Even in cases in which the risk has been transferred, an entity is still going to be required to pay additional premiums. So even though the entity, yes, we have insurance, it may still have payments that are due as additional premiums. And you have to apply the accounting for multiple year retrospectively rated contracts as detailed in the Accounting Standards Codification 720-20. Now, I know that not everybody is going to have some of these questions and issues, but hopefully this is giving you enough exposure that you can discern which one your client, which one your association has, so you can go back a little further. And then there's retrospectively rated contracts. It provides for changes in future contractual cash flows, including premium or settlement adjustments, or changes in the contract's future coverage on the basis of contract experience. The critical feature here is that part or all of the rating, the retrospective rating, is obligatory. In other words, this retrospective rating provision creates for each party to the contract future rights and obligations as a result of past events. And then there's another section, 720.20.25.15. The insured should recognize a liability to the extent it has an obligation to pay cash to the insurer that would not have been required in the absence of experience on the contract. So you need that. I don't want to try to make any of us insurance experts, but you really, if in some of the situations I've been involved in, I've had to go outside and get someone to react with me. Maybe it's an attorney who's experienced in insurance. Maybe it's an agent who will consult with me on insurance or some things like that. You just have to be very careful. And sometimes you may have significant damages caused by unforeseen events like a disaster that may indicate the liability has been incurred under retrospective rating provision. In other words, they can go back and ask for more money. And similar issues should be considered for single year retrospective rated with respect to interim reporting periods. So now, in a mutual insurance company, the members pay premiums that are pooled. They cover the losses incurred. But if they're required to cover large unexpected, it may have additional premium requirements from all members, or it may increase premiums over subsequent years. And this is what's kind of happened here in Florida when you end up when a lot of people went with the mutual companies, and these carriers had the money to take care of it, but all of a sudden they were faced with large premium increases later, and that's the reason so much of the deductible issue came in, because they simply couldn't pay or couldn't afford or felt like they couldn't to do those types of things. So in some cases, by analogy to ASC 720, entities with a contractual obligation requiring the insured to pay the additional premiums, even if the policy is canceled, will more likely incurred a liability that should be recognized. Entities not directly affected by any events may be indirectly affected. So you could have some situations that are mentioned here, like in ASC 450 and 460 in the guidance for accounting on multiple year retrospectively rated contracts. So there's some strange things that come up. Now, insurance recoveries are important. There's how do you get the accounting for involuntary conversions of property and equipment as compared to how do you handle the insurance proceeds. And this guidance does require some recognition of gain or loss on an involuntary conversion of a non-monetary asset to a in other words, the non-monetary asset would be the property and equipment. The monetary asset is the cash that you're going to get from insurance proceeds. And an involuntary conversion is considered to have occurred even if the entity reinvests or is obligated to reinvest the monetary assets in replacement non-monetary assets. So we've got some issues there that insurance is not just debits and credits. There's some unusual things that occur. Insurance recoveries, including the gains and losses, have to be classified in a manner consistent with the related losses, generally within income from continuing operations. Remember, these are not extraordinary items any longer, so it's going to be within the income from continuing operations. Now, you can have special categories within continuing operations, like losses from disasters, losses from hurricanes, losses from this, gains, so on and so forth. And occasionally gains will come into play. And it talks about ASC 10-410-30 handles guidance on the income statement display of environmental remediation and related recoveries like insurance. 410-30-45-4 states that environmental remediation related expenses shall be reported as a component of operating income in income statements that classify it as operating or non-operating. Okay. Now, timing, this is the big issue that we also run into. With respect to the timing and recognition of insurance recoveries, an entity needs to apply what's found there in the 5100.35 technical practice aid, involuntary conversions, recognition of gain for recoveries. In general, insurance recoveries that will result in a gain should not be recognized until they're realized. In other words, you don't want to show a receivable, but really recognize it when it's going to come in or when you've got some proof that it actually has been realized. Let's switch for just a minute now. I don't want to leave you too confused on the insurance. I just want you to understand that insurance can have some issues you might not expect or suspect right at the beginning. So it wouldn't be harmful or it wouldn't be at all unusual, even though you think you've got it nailed down, to have somebody come in and look over your shoulder. even if it's a colleague who may come in or somebody who understands exactly what you're talking about with insurance, attorneys, brokers, dealers, carriers, consultants, whatever. Now, one thing that I can tell you is almost for sure going to affect everybody, and that is a lease. If you have a lease and then you have a disaster. Sometimes those leases say that you're committed to the lease agreements for property that has been destroyed or permanently lost because of damage resulting from a disaster. And your insurance may not cover that type of thing. It may be specifically excluded. So 420 says that if an operating lease is not terminated, the associated asset has no future economic benefit, then you've got to recognize a liability as of the cease use date at fair value determined on the basis of the remaining lease rentals, reduced by estimating sublease rentals that could be reasonably obtained for the property, whether you intend to do it or not. So sometimes you could have a lease. It might be a very expensive copy machine. It could be office furniture, fixtures, and equipment, maybe even IT equipment like computers, printers, that sort of thing. And if they're damaged and you've got the lease out there, you may still have to pay for the lease. But that's where the lease and the insurance kind of go hand in hand to make sure. And by the way, this is a great question to ask in advance. If we have this big lease, let me give you a quick example. Let's say you have a resort community, and maybe your resort community has some leases that they have incurred as the lessee on maybe docks or outdoor equipment or other things that are fairly large in nature. And you don't know, maybe a 3, 5, 6 year lease, what happens if a hurricane hits? Are you still liable? And that's a great question to ask on the front end now before you ever have a need for it. And then you can take care of handling that type of an issue, either by getting the proper insurance, rewording the lease, or try to arrange something a little bit different. Now, the liability for cost to terminate a contract before the end of the term has to be measured at fair value when an entity terminates a contract. And there are other things in these particular issues about guidance on the overview of insurance analysis and insurance recoveries. There are many, many practice guides on insurance that talks about all these things, and you could take a look at some of those issues. It's a good thing to Google up maybe things like insurance recoveries or other issues, and you can find some of the answers. There's so many things we've got to cover. We don't have time to get into each little detail of all this. I realize that and understand I'm trying to give you some thoughts as to what to do when it occurs. You may also need to add to document disclosures in both the footnotes and the financial statements and the MD&A about the impact of a disaster that may have recently occurred. Entities may need to discuss amounts of losses incurred and claims recorded and the expected ultimate insurance recoveries. What do you expect to happen? MD&A disclosure should address the reasonably likely effects of known trends and uncertainties. There's a lot of issues that come in here about notes and disclosures and what's got to happen. The main thing is to be forthright, straightforward. This is not trying to word it like a hidden trap contract or something like that. This is just trying to say, be straightforward, open, and honest with your disclosures. And then for the other things on disclosures, a description of the nature and amount of losses and costs to recognize the results should be recognized. And use common, plain English. Don't get into all kinds of wording that people just simply don't know and don't understand. And then we get into the description of the contingencies resulting from the event that's not yet been recognized. We're going to talk about some more of those issues as we get into it. And there's disclosures under ASC 275 and some disclosures about environmental obligations and recoveries under 410-30. Now, I want to mention a couple of things that have occurred here in US GAAP this was a standard. It bears a little bit of history, a little bit of background. When the FASB had just released its codification in 2009, and the Auditing Standards Board of the AICPA was going through its clarity process, and they ran across two issues that they were looking at. One was on subsequent events, and one was on going concerns. And the ASB of the AICPA asked the FASB, would they mind issuing their standards to include subsequent events or going concerns, because it looked like that the older standards for those things were causing the auditors to have to consider the disclosures. It should be management disclosures, not auditor disclosures. Auditor has to evaluate the reasonableness and correctness of the disclosure, but not make the disclosure responsible for the auditor per se. FASB took a look at subsequent events and said, hey, no problem, we can issue this. They issued 2010-09. This was several years ago. And it's under subsequent events is what was happening. Here's polling question number 4. Polling question number 4, Adam.
Thank you, Pat. Number 2010-09, February 2010, refers to subsequent events. True or false? Number 2010-09, February 2010, refers to subsequent events. True or false? And for those of you who have not already signed up, there's still time to sign up for this afternoon's disaster recovery related webinar as well, if you're still interested in joining us. In the meantime, I'll go ahead and share the results from this poll. 93% said true, 7% said false. Back to you, Pat.
Thank you. Oftentimes after disaster, and those in South Florida saw it with Andrew, we've seen it even in North Florida with Maria and other areas. We saw it over in the Panhandle. It's all over the place. Many affected areas can remain inaccessible, and the damage estimates may not be available immediately. They're going to come out over time. So the entities and their independent auditors are therefore carefully evaluating information that becomes available after the balance sheet date, before the issuance of the financial statements.
Pat, are you there? My apologies, ladies and gentlemen. Please bear with us. We seem to have lost contact with the speaker. We'll be back with you in just a moment. Once again, ladies and gentlemen, please bear with us for just a moment while we reestablish contact with the speaker.
Adam, I'm back. Everything okay?
Yes, Pat, thank you. Just lost you for a moment.
Okay. Not sure what happened, but the end result was the telephone line went dead. So
Not a
I
problem.
apologize for that.
Feel
Okay.
free to resume.
We were talking about the subsequent events deal here, and we say that the entity is recognizing in the financial statements the effect of all subsequent events that provide additional evidence about conditions existing at the date. And there's some examples of the paragraphs and what should be happening. An entity shall not recognize subsequent events that provide evidence about conditions that did not exist at the date of the balance sheet, but arose after the balance sheet date, but before financial statements are issued. So there's some examples of that that are also shown. Now, we're going to move into a little more issue with audits and talk about some auditing issues as we go forward. First of all, I want to caution you that remember the CIRA guide is considered obsolete and not authoritative. The CIRA guide does not recognize any of the new clarity standards, so it hasn't available for about the last 7 or 8 years. So don't use the CIRA guide. If you have it, my suggestion is destroy it. SAS 118 was something that came out, and this is very important in the disaster area because this is dealing with information and documents that contain audited financials. The audited financials oftentimes are married or coupled with the president's letter to the association members. And you want to be sure that in the president's letter, you don't find things that are contrary or misleading or different than what's in the audited financials. You don't want the president's letter to say, best year we've ever had, and the auditor's report says this is a going concern because of the hurricane. So you've got to be a little careful with that one. And CIRAs often do this, and this supersedes the requirements and guidance in an older section. 119 and 120 are both dealing with supplementary information. Now, this is very important, in particular in regards to disaster accounting and disclosures. Easiest way to keep these in check is to remember that SAS 119 on supplementary information is audited. SAS 120 is not audited. Okay, so let's talk about 119. This is where you get into supplementary information that is audited, it's covered by the auditor's report. Maybe somebody wants to see what was the damage incurred in a disaster by category, and so you do a supplemental information that has been audited. And that's usually put in right behind the financial statements, and titled supplementary information is also mentioned in the auditor's report. Now, if you're using proper audit programs, they're going to have a bunch of questions that talk about supplementary information, making sure that it comes from the requirements that are going to be needed to meet the requirements of what's in the auditor's report. In other words, the auditor's report is going to cover this supplementary information, so you've got to make sure that all of these little questions here are part of what's handled in your audit programs. 120 is dealing with the so-called required supplementary information. Now, this has actually found its way not only into audits, but it's also found its way into reviews and compilations and even preparation statements. Required supplementary information. And what happened to some of the disclosures for CIRAs, they found their way into the FASB standards. And the FASB standards are under this section 972-235-50-3. This is 972 is specifically for CIRAs. A lot of people still don't recognize that. So what happens? You go to FASB.org, you click on standards, you click on accounting standards codification, and then you can see a drop down, and there'll be all the little details of presentation and income and expenses. And down at the bottom you see industry. Put your cursor on industry. There's a sidebar that comes up, and that says different types of industry. One of them is real estate. Put your cursor on real estate. Another sidebar comes up with 5 or 6 real estate types, and one of those is common interest realty associations. When you put your cursor on that, that's where you find 972-235-50-3. This is information that's required by a designated accounting standard setter other than the AICPA. It's not part of the basic financials, but it's a designated accounting standard setter program that's supposed to be there. And there's some authoritative guidelines on what it's doing. For CIRAs, it's extremely important to have it in there because this is one where this is not GAAP reporting, but it's so important it's considered as necessary to the point that if it's missing, then you got to disclose the absence. This is where you get into some unusual matters dealing with what's got to be there, and we'll go into that before the end of today's session. Now, the Clarity project has basically been completed now, and we've got a couple of things that could impact during this area. The big one, though, is SAS 132, which was recently issued in February of this year. 132 deals with the auditor's consideration of an entity's ability to continue as a going concern. It supersedes SAS 126. Remember what I said about subsequent events, that the Auditing Standards Board asked the FASB to issue FASB statements dealing with this. Well, they did. They did with going concern and with subsequent events. And it was only after they came up with 126 from the Auditing Standards Board that the FASB said, okay, we see that it went through Clarity, therefore we can go ahead and follow through with it. So we'll do that. And they follow through with going concern. Now, the going concern issue here is really just kind of saying, let's talk about this polling question number 5 first before I get into the details. Polling question 5, Adam?
Thank you, Pat. SAS 132 relates to the auditor's consideration of an entity's ability to continue as a going concern. True or false? SAS 132 relates to the auditor's consideration of an entity's ability to continue as a going concern. And I just want to correct, earlier I mentioned that registration for this afternoon's presentation is still open. It is closed on the website, but if you contact the Member Service Center via phone or email, they can still get you signed up for it. So my apologies for the confusion on that. In the meantime, here are the results for this poll. 96% said true, 4% said false. Back to you, Pat.
Thank you, Adam. We won't spend a lot of time on 132, but it is very important. The FASB has issued a standard at the end of 2014, which dealt with going concerns, and basically it had the requirements and issues for what is a going concern and how do you handle and look at it. And what it boiled down to is it said, management, you're responsible for going concern disclosures, but the CPA, obviously, in many cases, is going to still be responsible for helping the management come up with the correct disclosures and what's got to be there. So what they're saying here with 132 is even though you may have a set of financial statements that is prepared in accordance with a general purpose or special purpose framework, like maybe tax or cash or some other basis of accounting that doesn't emphasize going concern and GAAP, the auditor is still responsible for coming up with many of those issues. So let's look at the third bullet point. However, irrespective of whether the going concern basis of accounting is relevant to the preparation of special purpose financials, the responsibilities of this SAS apply regarding the auditor's responsibilities to perform the following. You're going to conclude that substantial doubt exists and the other issues that come under there. And this applies even if the financial reporting framework doesn't specifically require going concern evaluations. Some don't, some do, that type of thing. One of the issues that we want to be very careful about is to understand that going concerns really deal with something that's going to be looked at for the future. And at the bottom area, number C, any judgment about the future is based on conditions or events that are known and reasonably knowable at the date the financial statements are issued or available to be issued. Subsequent events may change the outcome that are inconsistent with judges that were made. In other words, you may have something come up later that impairs or changes the judgment that was made at the time of this. And what we're saying here is that just because the accountant doesn't mention something about going concern doesn't mean there is not a going concern, because it is looking at the future. And the auditor cannot predict future conditions or events, and accordingly, the absence of any reference to substantial doubt is not a guarantee of the entity's ability to continue. Now, this is so important when you get into disaster accounting, because many times the disaster is so severe that there is a real issue about, are we going to continue this or not? And are we going to continue with this condo association, this condo complex? How are we going to do this? What's going to happen? And we go through 132's objectives and some of the things there. Let's talk about audit tips and tactics for CIRAs in disaster situations. This is one of the things that there's two parts here. First, this is if everything is available. And the second part to it, it should be available, but if it's not, why not? And I'm going to give you some ideas of how you can make it available. So first of all, to become familiar with all the terms and conditions, you need to get some of these governing documents. Obviously, the Articles of Incorporation, the bylaws, Declaration of Covenants, Conditions, and Restrictions, CC&Rs. Most of the time, they're just called the declarations. Here's polling question number 6. Polling question number 6.
As an auditor, there is no need to request copies of all the CIRA's governing documents. True or false? As an auditor, there is no need to request copies of all of the CIRA's governing documents. True or false? Got a little more disagreement on this one so far than usual, Pat. Give everyone about another 5 to 10 seconds to get their votes in. And here are the results. 14% said true, 86% said false. Back to you.
Thanks. And it is false. The auditor does need to get that, and there is a responsibility the auditor gets that. In addition to what we've just seen, there's rules and regulations, statement of current periodic assessments, copies of financial records, oftentimes more than 1 year if you can get it, and the minutes of the association's meeting the past year or two. You contact the association directly, and reviewing them can help you understand the major issues that will impact you during this situation. Now, Florida's got some statutory issues. We want to be sure that we look at Florida, because the question comes up, when is a CIRA a CIRA? A lot of times you may see situations where the CIRA is under construction, and consequently we don't know, is it really a CIRA or not? And what we see here is that this is the creation. And it says, every condominium created in this state, Florida, shall be created pursuant to this chapter. Number 2 says, condominium is created by recording a declaration in the public records of the county where the land is located. And all persons who have title, excuse me for jumping ahead, but I want you to go down, look at the, right in the middle, you see that number 718.4036, then it starts out, all units described in the declaration or phase as being located in or on the land after then being submitted to condominium ownership shall come into existence regardless of the state of completion. So if you're going to have multiple phases, but you put all the units in one lump in the beginning with the declaration, those units will come into existence whether or not they're built. So this becomes very important to take a look at, when is the CIRA a CIRA, and to understand that the Common Interest Realty Association is one when it's created by recording a declaration in the public records. So many people today will not do that. They will just list those that are going to be built. Definitions: when is a unit a unit? It means a part of the condominium subject to exclusive ownership. It can be in improvements, land or land and improvements together, as specified in the declaration. This is the amended version of this. Originally, it just says subject to exclusive ownership. And based on that, there was a case called the Hyde Park case, which was the phantom unit case.
And many of the association's units were units even though they weren't built. Here's the Hyde Park case and the site there. It was Hyde Park Condominium Association versus Estero Island Real Estate, Inc. And this was not dealing necessarily with hurricanes or disasters, but this was a case that dealt with units being units when the situation was there, and it could cause some issues and problems with disclosures and all of those things. There was another one, Wallaby Condominium. It said that the units were units when the certificate of occupancy was issued. So that changed a little bit, and based on, I'm gonna go backwards a couple. Here is where we say the first definition said ownership period. The second came up and added a unit may be in improvements, land, etc. So anyway, that looks good. Now, fiduciary duty. This is the officers and directors have a fiduciary duty to unit owners. This means they've got to have more than reasonable care. They've got to use some excess care. The records are supposed to be kept for at least 7 years. Many associations don't have these records kept for 7 years. Some of them had them for 7 years, but because of the hurricanes and other issues, tornadoes, etc., the records were destroyed. So they need to probably be kept currently somehow. One thing I'm recommending to a lot of associations they may want to consider doing, it's not that expensive, but it is very valuable to them in the end, is to take all of their old records and have them converted to digital format so that they're now can be stored digitally. So just some thoughts there. Current year. Financial reporting, 90 days after the end of the fiscal year or annually, they're going to have to prepare and complete for preparation and completion of the financial report. I don't know of any formal extensions that can be granted to that. I don't think there's a formal extension request form, but my experience has been that you can explain something because if the hurricanes hit, maybe you have a June 30 year end, and all of a sudden there's a storm in July or August or September, and you can't complete the financial report for the preceding year. So you may have to get special dispensation from Tallahassee in regards to what can you do. And then we get into what reporting requirements are actually required. And we see that the association with annual revenues of 100,000 are a certain way. It started out 100,000, it's now gone to 150,000. The red letters are what it is currently. One point I want to make to you is that the division of timeshares, condominiums, and mobile homes in Tallahassee will look at the insurance proceeds received as part of this revenue. The insurance proceeds received as part of the revenue. So consequently, if you have these issues that come in, the insurance proceeds will maybe inflate it to the point now you've got to have more than what you originally had. Okay, total annual revenues of less than 100,000, now it's 100 up to 150. There's another note here that says, this was part of it, the association operates fewer than 75, now 50 units. Forget that, because in 2017, that part 2 was changed, and the numbers are going to be based on revenues as to the level of reporting to be done rather than units. Revenues, not units. Revenue, not units. And that has changed. So, and then the cash receipts and disbursements and so on and so forth. I'm trying to get to a point here. I want you to see an association can change a couple of issues. Adam, by some chance, do you have your mic on or unmuted?
No, but do you need something?
Nope, I just thought that I was hearing some background feed into it. So not a problem. It might be my phone. Okay, no problem. No problem. Let's keep going. The report of cash receipts and expenditures can be issued in lieu of some of the others if they have the required meetings and take the proper vote et cetera, et cetera. Here's polling question number 7. Polling question number 7.
Thank you, Pat. Any audit or review prepared under Florida Statute 718 shall be paid by the developer if done before turnover of control of the association. True or false? Once again, any audit or review prepared under Florida Statute 718 shall be paid for by the developer if done before turnover of control of the association. True or false? Give everyone just a few more seconds to get their responses in. And here are the results. 89% said true, 11% said false. Back to you, Pat.
Thank you, Adam. That is true, of course. That is true. And when we do these financial statements in accordance with the Florida statutes, we want to make sure that we understand they've got to be prepared on the accrual basis using fund accounting in accordance with GAAP to meet the requirements. Reviewed have to be in accordance with the accounting review services, and auditing standards have to follow the generally accepted auditing standards or GAAP. And the reviews and audits shall be performed by an independent CPA licensed by the Florida Board of Accountancy. And it goes on from there with some of the disclosures that have to be made. The disclosures and components have to have these types of financials, and the disclosure requirements indicate that some reserve disclosures are made regardless of whether reserves have been waived by the association. So you've got to put this in even if the reserves have been waived. Now, this is not necessarily part of a disaster, but this is just if you're reporting at the end of a period of time, which just happened to occur with a disaster. And some of the times you find these reserve issues because of emergency proceeds can be used, emergency proceedings can be used even though they're not intended for that. For instance, you may have a large painting reserve. Well, if the roof is damaged to the point that it's causing severe interior damage to the units, then you can use some of the painting reserves in an emergency situation to do the roof. So just to let you know about those issues as we get into it, and that's where you would have this disclosures that come in under this situation. Now, there's also issues of sometimes what happens with the associations that are under construction and the developer guarantee is going on. The developer guarantee could be a little bit of an issue here if there's some damage and things that are not properly insured for, and the developer is going to be on the hook for if the developer has guaranteed something and then there's these substantial damages, the developer may be on the hook for some of those damages absent proper insurance. This is also true maybe when the developer has increased the deductibles to the point that they're pretty high. The developer may have to come up with those deductibles in the event of a disaster. Okay. Now let's talk about some disaster recovery situations. And here in disaster recovery situations, we really got all kinds of disasters. You've got hurricanes, that's primarily what we're focusing on today. Earthquakes, tornadoes, a lot of tornadoes in the hurricanes. There's other national disasters like floods and other issues that you could come up with that would constitute a disaster. The problem with damage in the settlements is that the monies received and dispersed are based on damages and settlements, have major considerations like the timing of the receipt and the relation to related expenditures. You may get the money earlier or later than when the expenditures are needed. Do the proceeds relate to the association's own property? In other words, in an association, you may have property that's owned by the association or property that's owned by the unit owners, and the association gets the proceeds. What do you do with that? And then sometimes it's generally based on the matching principle. We want to be sure we understand that that is very, very important. And because of that, we may have some deferred expenses or deferred revenues that we need to account for because of the matching principle. And insurance or settlement proceeds are going to be treated as revenue for determining the level like audits, reviews, or compilations that the association is going to have involving the state. Now, it's not always possible to match revenues and expenses, even though we want to try that as much as we can. Under 5400.05, we see issue number 4, and we recognize that usually the settlement and repair work do not occur at the same time. Now, there's several recommendations that I'm going to make to you for all situations, regardless of what happens. All situations. Use a separate fund for receipts and expenditures. In other words, create maybe a disaster fund, create a special fund, whatever you want to call it, it doesn't matter, but treat a separate fund for the receipts and expenditures related to the disaster. Also, the association can use the replacement fund if you want to, but I would be very careful. I like the separate funds. And then I would suggest you even use separate bank accounts for the different funds, because the separate bank accounts for different funds creates a very easy trail to follow. It's not like, well, what was this deposit or what was this expenditure for? We know because of the funds that it occurred in usually. And then you have the accounting rules that follow those same types of things. So separate funds for receipts and expenditures for the disaster. You can use the replacement fund if absolutely necessary for an emergency. And the association should consider using separate bank accounts for the different funds if you possibly can. So the situations I want to mention to you is that don't panic. Just simply don't panic. Don't panic. And we're going to be doing a lot of issues with situations like that. So here's some possible things that we're going to be talking about. The first one is settlements are received before work begins and the total cost can be reasonably projected. That's pretty easy. The second one, though, settlements are received before the work begins and no reasonable cost can be projected. A little more difficult. And then construction has begun or completed and there's strong confirmations of the amount of the settlement. Important. And then the settlements are related to the member's property, not necessarily the association's property. And then there's litigation expenses. And do we capitalize or expense situations? That's something that we're going to have to look at. Now, one thing we're going to be doing in the next few minutes, we're going to go through some examples of that. But I want to caution you, just when I finish, I want you to stay on for just a few more minutes because we have a treat coming. We're going to have someone else join us and speak to us for just a few minutes, and we'll be able to see and hear that in a few minutes. So it's situation 1. On occasion, repairs may be cosmetic as compared to structural. So we can delay the repairs because of the cosmetic nature, not the structural. And we can delay them until we get the money. Now, once settlement is determined, the association should record revenues for the proceeds. The old FASB Statement 5, accounting for contingencies, did require recording a liability at balance sheet date if probable and reasonably estimated. So just so you can understand what that one might be, let me take you back a minute. We can delay repairs, literally physically delay the repairs until the settlement is received. And then once we get the settlement, we can then make the repairs. We record the revenues, and we record the proceeds, and we record the expenses for the repairs, and we can match it that way. Now, if we're not absolutely positive, I would suggest we follow the contingency thing and say, we're not going to record it yet until we get the money, we know what it is. But if we do know, many accountants take a more conservative approach, and they'll show, well, we've got this liability that we're going to have, and we're going to record an asset and a liability for contingencies, but maybe we should put it into construction in progress as an estimate of what it's going to be, and then the liability as a contingency. And then once we actually get the settlement, we reverse all of that and do the matching. So it's a good way to look at something like that. Okay, situation 2. Situation 2 is that the settlement proceeds are received prior to commencing repairs, and repair costs cannot reasonably estimate. You get the money in, you don't know what the repair costs are going to be. Debit cash, credit deferred revenue. That's the easy way to handle it. And once the total costs are determined, then we record the liability and recognize the revenue, and we get into the expense side of it. So it's fairly straightforward. In this one, the repairs are needed before settlement or insurance is received. In other words, we've got structural damage. We've got to fix it now. The settlements may take years to get the numbers in. So we probably want to try, if at all possible, and reasonably considered, to defer the construction costs, maybe by debiting construction in process until the settlement is received or recognized as revenues. Sometimes we may have to make some payments out, so we create a situation where we get money coming from other things, or borrowed money from reserves, or borrow money from, or get money from the association. And when recognized as revenue, then we record the deferred expenses and accruals for uncompleted items as expenses. So begins matching concept kind of still comes into play here. When the settlement proceeds are not enough to make the needed repairs, we know that's going to be the case because of deductibles or whatever, then we've got to have the contingency for accruals if they're probable and reasonably estimated. Now, probable, what do we say is probable? Most people use 75, 80% probable. So it's a pretty high threshold, Situation 4 comes in. The settlements are received after incurring expenses and totals, but we can't really determine what they are. So repairs may be made without settlement or proceeds, and settlements or proceeds are not likely or enough to cover, then you just expense the costs when they're occurred. So we get the settlement after the expenses, but both the revenues and expenses can't be determined. So repairs can be made without the proceeds, and then the settlements will come in later, and CIRA should expense costs when incurred. 5, when payments are made to the association rather than the owners, the payment should be reflected as a liability to the association. What do we mean by that? Well, this may be like a condominium unit, a condominium association. Here we've got the money comes in to the unit owners. The unit owners have the insurance, they have the insurability, not the association. So it's really the owner's property. They own the undivided interest in the private unit. So consequently, it's for them. It's for them. So let's focus on how we're going to do this. We actually are going to debit cash, and we're going to credit due to the unit owners. And then when the unit owners decide what to do with the proceeds, then we're going to reclass it back to either revenue, special assessments, or other accounts. Remember, it's difficult to, you may have to actually make the repairs for the unit owners rather than the unit giving the money to the unit owners. That's the best thing to do, is cause the repairs to be made. But a lot of times it's to structural stuff, not just the interior spaces that the unit owners own individually. A lot of times you may have investigative and legal work that's going to be incurred. It may be something to do with insurance or others. And expenses are incurred and should be incurred and recorded when they happen. Title is the primary consideration. Homeowners and cooperative owners generally record the funds as the CIRA funds, because they're usually, those things are going to be made to the association for property damage to the clubhouse, swimming pool, maybe golf course or other things, roads and streets. Very seldom in a homeowner or co-op will the unit owners be entitled to those funds other than repairs on the association's property. And so consequently, you're just going to do it. And condominiums, it's a little different. You get funds for the members as title. Because title is in the member's name, you get funds as a collection. So consequently, you're going to debit cash due to the members in a condominium. But in the homeowner and co-op, they own the money, they own the things that are going to be fixed. And so they should record it there in that way. Now, let me conclude with a couple of things that we're going to be talking about. This will probably take about 3 to 5 more minutes, and then we'll be wrapping it up. But don't go away, because we've got a special guest. We want to have someone, I want you to really listen to it, because it's very important to us all. First of all, for disaster planning and CIRA doc, very important. This may be one of the most important things we can talk about today. We need to review the areas about disasters and insurance. Who's going to get the inquiries? Who's going to have the backup records? What can boards do in event of disasters? What are the requirements for an insurance trust? And who are payments being made to? And what are the procedural and notice requirements? These are issues that should be done very much in advance. There's special audit considerations, confirming trust account activity. You may have to have special assessments receivable and audits done on that. You may have contingent liabilities with contracts. Maybe it's something like a lease. You need to confirm loan balances and terms, if any. Pay particular attention to the board minutes, see what they say they're going to do, and have the risk assessments and the internal controls that come up. You want to be sure that the representation letters are all properly done and worded and handled, you know, with the correct form and the correct procedures. Now, I want to be sure that we do certain things in advance, and one is to understand that we've got to have this disaster plan. That's not GAAP, but in my judgment, this is just my judgment alone. This is so important to have the proper disaster plan that I would consider it personally a significant deficiency in the association's internal controls if they fail to have a disaster plan, because there's so many things that are so important. It hinges on the existence and continuation of the whole association to have a plan. When you disclose the details of what happens, it could be hurricanes, anything else, disclose it simply, straightforwardly, and plainly. On such and such a date, Hurricane Maria struck the state of Florida, and it damaged the Condominium Association, it damaged the homeowners. Just say it straightforwardly and give the details as much as you can. And then report your insurance deductibles in footnotes. And maybe even consider an emphasis of matter paragraph for that footnote or the disclosure of what the $100,000, $200,000, $300,000 deductible is, and the fact that it's going to be, where is it coming from? Who's going to do it? What are the insurance proceeds and the special assessments received? How are we going to summarize that? And then how are we going to show what contracts we've had? Do we have any contracts that are ongoing that will need to be completed? Like leases, maybe there's property management contracts, maybe there's contracts with other things for issues involving different types of things that come up. And then there's some supplementary information that may come up that we need to have in there, like what type of insurance did we get, what's the disclosures, how are we going to handle it. Future suggestions, recommend that the owners vote annually in advance to allow use of reserve funds in case of disasters. Very important. The roof is off. We need to put a tarp or something on it, so we need to use those funds from the painting reserve. Let's vote now that we can do that if it's in case of a disaster. The best time to get a line of credit is when you don't need it. So you don't need the line of credit now, arrange the line of credit now. There may be a slight charge with it, not a big deal, but at least you've got monies to operate should your whole facility be destroyed. Consider the pledge of reserves or special assessment as collateral if needed. And then we might want to recommend that owners use a hurricane deductible as a replacement line item and a replacement budget if material. In other words, actually budget and come in with a hurricane deductible as a line item for reserves. Here's polling question number 8. Polling question number 8.
Thank you, Pat. A good recommendation is that owners should vote annually in advance to allow use of reserve funds in case of disaster. True or false? Once again, a good recommendation is that owners should vote annually in advance to allow use of reserve funds in case of disaster. True or false? Just a few more seconds. Let the last few voters get their vote in. And here are the results. Everyone's in agreement. True. Back to you, Pat.
Okay. In conclusion, I want to thank everyone for being with us. And there is a question that did come up I want to answer very quickly. The question reads something like, if insurance proceeds are received and are classified as deferred revenue, is it that revenue wouldn't be considered for comp review audits until actually recognized as revenue in the subsequent year, correct? Yes, that is correct. The deferred revenue aspect would be deferred, but you're going to have to disclose the heck out of it. You're going to have to disclose the heck out of it. Here's another one. Doesn't the emergency powers passed in 2008 allow associations to use the reserve funds in case of emergency? Yeah, but you probably want to be sure that you have the approval of the unit owners and the board in advance. That just takes care of the so-called due diligence and all of the issues involving the various ways of the care that they're going to have. And so it becomes very important. Well, at this time, I think we're going to have a real treat, and I appreciate Deborah taking the time out of her busy schedule to address the group. And with that, Adam, I'm going to turn it over back to you. You've got it.
Thank you, Pat. I would like to take a moment to introduce Deborah Curry. She is the CEO of the Florida Institute of CPAs, and she's entering her 7th year with us. And she wanted me to let you know she has a passion for representing the FICPA. And I can tell you, I have seen it. She definitely is passionate about that. And she wants to make sure that you are aware of just how much we're doing on your behalf. And part of that, she wants to highlight the legislative efforts that we're making, and in particular, the disaster-related legislation that we have recently been working with. It is a high priority for us. And to that end, I'd like to welcome Deborah Curry to the presentation. And Deborah, I turn it over to you.
All right. Thank you, Adam. And thank you, Pat. I was listening in today, and that's a great presentation. Adam, are you able to see my screen?
Yes, ma'am. We can see your screen. It looks great.
All right. Well, thank you, everyone, for letting me join you. And what I would like to do is take a few minutes here to talk with you about the efforts of the AICPA and the FICPA together when a hurricane or a disaster is approaching of this nature, and all of the things that we did to try and help our CPAs in light of this very stressful time, especially as it related to the fact that we had a September 15th deadline approaching for tax filing and payments. I received many emails, many phone calls from our CPAs across the states and the Virgin Islands and Puerto Rico asking what in the world we were going to do with these impending deadlines when our own members of our state were being asked to evacuate or were packing up and trying to protect their own families and businesses. Certainly the filing of tax returns was not first and foremost in their lives, nor should it have been at that point in time. So our staff got together, and even while we were packing and trying to secure our offices, we determined that we were going to have to do a lot to try and help our members with this filing deadline disaster that was impending. So let me tell you a little bit about what we did and how our legislative efforts and advocacy are actually the main benefit that we provide to you at times like this to try and mobilize the CPA community and provide support for all of us together. What we did do was we began working on the efforts to lead the profession as far as disaster relief legislation. And one of the things we did is we created a website for the disaster relief so that we could continually update you on the latest resources or the latest developments that were coming out of either the IRS or the DOR or any number of FEMA organizations. And this microsite that we developed with our marketing company, which did a really great job overnight, we also were able then to reach out to you via mass email, letting you know that we were trying to work on this issue. Also reaching out to you to make sure you called us if you needed anything at all, so we could try and mobilize not only our staff here, but our members across the state to help you. We had our member services department was actually calling out to some of our members that we anticipated would have the worst of it down in the Keys and the South Florida area. And we also mobilized to start writing our disaster relief assistance letters to the governor, the IRS leaders, and any number of our legislators, really asking them to ramp up the help message to the IRS. Another thing that we did that we looked at on this website is that we wanted to have ongoing updates. And the designation of the FEMA designated disaster counties is what so often spurs the IRS or the DOR to actually declare that you can then have a tax extension deadline. And many times you cannot get those extended deadlines until FEMA is designating counties as disaster areas. Well, of course, what has to happen first, you have to have the storm or the disaster come through in order for that to happen. That was not helping our CPAs who already had the deadline looming ahead of them and needed to know that the deadline was in effect extended while this hurricane was coming in and approaching. And that's what made this situation so difficult. So on the website, what we were trying to do in the meantime was to list resources for assistance for you. We were also trying to let you know what we were doing with the DOR and the IRS, and trying to post the latest updates that they would have on the declared disaster counties. As they came about, we were trying to post these overnight and using our social media as well. So you can see that while the hurricane was here, we were really trying to get some relief for you and working with our Q&A, trying to get technical answers situated for you so that we could do something together in a collaborative effort. We had individuals, even at the AICPA, were working with the IRS directly because they're up there with the federal contacts right down the street. We were sending emails, and we were actually texting back and forth with the CEO and director of the Department of Revenue. He took a specific interest in talking to us because of the sales tax deadline and was really trying to work through these issues of getting extensions. We had members who are directors of our CPA PAC, and this is where your political action committees come into play. They were sending out letters and on the phone with the staffs of the senators of our state so that our senators could get to Washington and get the message out that every county in Florida should be declared a disaster area for tax extension purposes immediately. And thank goodness that we were able to work on that. We believe that all of these efforts combined were what caused the tax extension deadline to be declared by September 15th. We didn't get all the counties in the day before or the day before that, but as they were coming online, we asked them to facilitate accelerating the notice so that by September 15th, I think it was maybe 9 o'clock at night, we had all 26 counties declared as available for tax extension relief, which hopefully allowed some of our CPAs to take a breath and know that they weren't going to have to try to sit in 12 hours of traffic getting in and out of the state, that they had a breather. And so we were thankful that we were able to get that done so quickly. Generally, it takes weeks after a disaster to have that kind of declaration. So that's where the strength of your PAC and your community come in together. And we're trying to lead those efforts. We're trying to communicate with all of the different entities that we need to speak to. we have a great relationship with our local IRS liaison. And that is critical to getting the message moved up the ladder when it's a matter of such importance as this is. We also wrote letters to Governor Scott's staff, and we were on the phone with his staff leads so that they could try and push more of the effort. And you saw the governor working so hard to get trucks with fuel into the state, trying to get disaster roads declared and also get disaster counties declared, so that you could be getting that individual assistance as well as the state assistance. And we had a very good conversation with the IRS Small Business and the Single Employer Division Commissioner. And I am hoping to again meet with Commissioner Murphy in November to discuss more permanent efforts for tax relief on disasters. So we're going to continue those efforts. We're going to keep pushing our senators. We're going to keep talking to the IRS and promoting situations such as this, where we have Pat and other experts talking about disaster relief, what do you do in the case of emergencies, and actually becoming the state that has these resource efforts known for the other states to come to. We want to be the go-to specialists. We also wanted to warn the public, as well as you should, about all the insurance scams that come about. Let your clients know about the AOB, the assignment of benefits, that they need to be very careful before they sign any documents with contractors. There's a series of steps to go through, and we have some resources on that. But that's really important, and everyone in the state, including the CFO, Jimmy Petronas, is well aware and is putting out the message on those warnings. So we'll continue with our disaster page, irma.ficpa.org. But eventually, I want to see that turned into disaster.ficpa.org. So we have it out there for any disaster at any time. We have continuing resources, and we want to make sure that we can talk about these disasters as a group because there will be more of them, and we want to be the resource and entity for the state of Florida. And we appreciate all of you and the hard work you're doing. And we entertain any questions you have on these issues related to taxes, filing deadlines, whether other states can use our disaster tax relief if they have entities that are located in Florida. And yes, there is a provision for that. So to that end, if you have any questions at all, please let us know, and we'll be the resource that hunts down those questions and answers for you. So with that, I'd like to end my presentation and just let you know that we're here. And again, to thank you for being on the webinar today.
Thank you, Deborah. That wraps up today's webinar. I want to thank everyone for your participation today. If you have any individual questions for the instructor or for Deborah that didn't get answered today, feel free to contact Pat via email. As a reminder, his contact information can be found in the easy materials. For the rest of you, you should have received an email from me earlier this morning, so feel free to send your questions to me, and I will make sure they get to Deborah. CPE credit for this program will be posted by close of business tomorrow and appear in your CPE tracker. After the session ends, you will receive a link to an evaluation. Please take a few moments to complete it, as it helps us improve future FICPA offerings. If you're interested in further continuing education programs, please visit the FICPA website, www.ficpa.org/CPE. Once again, on behalf of the Florida Institute of CPAs, we want to thank our presenter, Cecil Pat Patterson, and most importantly, thank you to the attendees. We hope you found this information very helpful, and we appreciate your participation. This now concludes our program.